Hello, everybody, and welcome to our webinar today. Today is May 23rd. With me today is Doug Johnson. Doug is our senior investment guru here at HCM. He manages our investment committee. Along with Doug is Dan Rinck. Dan is an investment strategist at HCM and an excellent market technician. I take care of some odds and ends around here. I work with clients in a strategic setting, and I also sit in on the investment committee. So today we're going to be talking about a handful of different items. We've got a slightly different approach today. Some of you may have participated. We took a survey on how to hopefully improve these webinars a bit, and we're going to be trying to handle them a little bit differently. The slides are a little more concise. We're going to try and hold the sort of technical discussion to about 30 minutes. We've each planned to have about a 10-minute presentation, and then we'll open for Q&A. So hopefully that will work well. We certainly welcome anybody's input on how to make these better for everybody. The batting order today will be Doug will go first. Doug is going to talk about the debt ceiling, which you can't turn on the news without hearing about the debt ceiling these days. I will go second and talk about the prospects for recession and what that might mean for the portfolios and how we might handle that. Dan is going to sort of counterpunch me and talk a little bit about what if instead of a recession, we have sort of just a mild slowdown, or what's often referred to as a soft landing. So that's basically what we have planned. As always, there is a Q&A button at the bottom of your screen. If you'd like to submit questions, we will absolutely make time for those questions at the end of the webinar. The one thing I would like to say before Doug begins his comments is just a reminder that everyone here at HCM, or I should say that we are not in the business of predicting the short-term pluses and minuses of the market and trying to guess what's going to happen tomorrow or the next day. But rather than predicting, we're here to help prepare for the various potential outcomes. And that's part of the theme of today's presentation. Is we're going to be talking a little bit about different things that could happen. At the end, we're not going to hide from our base case scenarios and where we think things are headed. But that's basically the way we want to lay things out, is to talk about the various possibilities and what we might do, and of course, how we would take advantage of the market cycles. So with that as sort of a precursor, Doug, why don't you lead us off?
Sure. No reason to bury the lead here with the debt ceiling. It's a topic that is obviously very important, but I will be very happy when we can stop discussing it. So obviously, a very, what I would say, serious situation that probably has a lot of political brinksmanship that's coming along with it. So to, I guess, supply some brevity to the situation, the title of this slide is worth 1,000 words. So you can see here that this probably does the best job of summing up exactly what's going on. You've got an elephant here that's representing the Republican side, that's telling the donkey to cut spending. The donkey representing the Democrats is saying raise it. And then what I think is a groundhog is popping up and basically saying, "Are you kidding me again?" And it kind of feels like that. I mean, this has just come back into the news cycle, but this has been a reoccurring negotiation now for a very long time, and we're going to get into the details of that. One other thing that I think is worth pointing out is that whenever this pops up, there is certainly a lot of finger pointing and the kind of blame game to go around. But as you can see on this chart, very clearly it shows that the debt ceiling has been risen irrespective of who is in the White House. So you've got red bars representing Republicans in office, blue with the Democrats. You've got these green bars that actually represent debt ceiling suspensions, and we'll talk about that a little bit. And then this very skinny purple bar here represents extraordinary measures, some of which we are in right now. But I don't think there's any doubt that there's two colors down here, and this line moves from lower to higher. So whatever you're hearing in the news, finger pointing, blame game, I think it's important to remember that both sides are responsible over time for being in this situation. And unfortunately, here we are yet again. So looking at a flow chart of various scenarios of what could happen here, I thought this broke down the kind of decision tree pretty well here. And it starts at the top and it said, hey, Congress can, and we've got this way pretty easy. We can pass a timely deal. We can move down here. We can raise the debt ceiling. And for the most part, we can be done with it. Unfortunately, we are here where we're still negotiating. And at this point, we've failed to reach an agreement. So the complications come from the offshoot of failing to reach the agreement. You've got over here various congressional maneuvers that could be implemented. We'll touch on a few of those. We're not going to get into all of them. I guess I should have said at the start of this, we could probably hold an hour-long webinar on just the ins and outs of this process, but the goal is just to focus on the main points of this so everyone gets the gist of it. So there are some congressional maneuvers that can be used to still reach the ceiling. But I think what everyone's concerned about is the decision tree on the right. So fail to reach an agreement would potentially lead to letting the X date pass. Now, the X date is really just the theoretical date where the government's cash account basically runs out and the ability to pay all the obligations comes into question. So when you hear the X date later on, that's what we're referring to here. If that date were to pass, at that point, the Treasury needs to decide which payments to default on. Now, I don't necessarily like the word default in this chart, and I'll explain why, but for now, we will use it. And then the worst case scenario, if nothing can come out of all this, there would be a ultimate default on the debt. Now, I think there's definitely some important things to know here. So what does each side really want? And as we saw in the cartoon earlier, the Democrats want a clean ceiling increase. They just want to raise the limit with no cut in spending, while the Republicans want a decrease in federal spending going forward. So each side is trying to negotiate what they want. I think they all realize what's at stake here. So hopefully they will come to some sort of agreement at some point. But they're certainly pushing this down to the wire, so to speak. So when is the actual X date? So you're going to see estimates ranging from as early as June 1st to as late as early fall. And a lot of that uncertainty comes from timing of tax payments. So citizens pay taxes, the government receives those tax payments, and then they can go ahead and put it in their, we'll call it the general account, to go ahead and pay obligations. So due to the kind of lumpy payment of taxes, and there's some nuances of this from certain states, I don't know that anyone knows exactly when that date is, but there's a lot of estimates. I would say that the consensus is for early to mid-June, which makes this seem a little bit more urgent, but I would not put that in stone. And if you see somebody say the X date is definitely blank, I would not maybe take that at face value. So could there be a default on Treasury bonds? So it's possible, but what I would say is it's unlikely. So in an event where you got past the X date and there needed to be some prioritization where the money goes that's remaining, interest and principal on U.S. bonds would most likely be prioritized, meaning that interest would be paid on time, and any principal reductions or any principal coming due would also be paid in full, because we've seen the word default thrown around a lot. And when you think about sovereign defaults, they're very serious matters. And you look at some historical defaults that we've seen, places like El Salvador, Argentina, Russia. Those have all been instances where the countries could not actually pay back the principal for those bonds, and you saw rates skyrocketing because the compensation needed to then invest in those bonds greatly increased. I don't think what we're looking at here is the same type of situation. You have to remember that really any country that can print its own currency technically can't have a real default on the ability to quote unquote pay back principal or interest. This is simply around a limit that the Treasury couldn't go over. So it's a theoretical ceiling, so to speak. But the idea that somehow the government couldn't actually pay these obligations, I think, is a little bit misleading. So ultimately, I think interest and principal on U.S. bonds would be prioritized. And then you would probably see cuts or delays in Social Security and Medicare payments, along with delays to government agencies and or contractors. So has this happened before? Yes. The debt ceiling has actually been raised 78 times since 1960. So that's a big number. Obviously, all of these situations haven't had the fanfare and concern that we were seeing right now, but the current situation is drawing comparisons to 2011, when a deal was reached only 72 hours before the X date. If you remember, then we had ultimately resulted in a downgrade of U.S. debt from AAA, which is the highest rating you can have, to AA plus. And then the result of that was some significant market volatility over the next few months. So what are the scenarios that we're looking at going forward here? So obviously the best one for everyone is a deal. That would mean an agreement is reached, the limit is raised, and we have no significant effect on economic growth. I think that's the one that everybody's hoping for, but at the same time, our concern is not going to get done. Next would be a temporary suspension, meaning there's an agreement to suspend the ceiling for a short time or until Congress meets again in September for budget planning. If you remember the chart that we had at the beginning, you saw a lot of those green bars in there showing suspension. So this has been done several times. Now, it's only a temporary solution that would just kick the can down the road, and this would come up again at some point in the future. But for some short-term reprieve, that is an option. And the worst case scenario, obviously, is that the standoff passes the X date. Now you're looking at things like a possible debt downgrade, reduction in economic growth forecasts, increased market volatility. And I would say the longer the standoff lasts, the more impact to financial markets, really bringing in the possibility or the increased possibility of recession, which Mike is going to touch on in just a second. So what's our take? So the HCM take is, we believe that both sides really understand what is at stake and will ultimately work out a deal. We would view any short-term market volatility as a buying opportunity, since the chances of long-term standoff is highly unlikely, given the severe effects it would have on financial markets. I know both sides are talking tough, so to speak, but they've talked tough in the past. So I think any volatility that was generated from this, I think should be seen as a short-term issue. Now, it doesn't mean that these issues can't roll over into the intermediate and long term, which Mike and Dan are going to talk about a little bit. But for now, without serious language around letting things really get out of hand, we think that there's a lot of, again, political brinksmanship with this, and we ultimately think that this is going to get resolved in a way that is not quote unquote the worst case scenario. So Mike, now that we've covered the debt ceiling and both the good and the bad paths here, why don't you give us your take on maybe what a recessionary environment would look like and how that would affect markets?
Okay, well, my official recommendation is hide under the desk. That's the
Okay.
So I'm also going to start with the chart, but basically what the chart shows is that there is a sort of a parallelish track here between the market cycle and the economic cycle. The reality is that markets and the economy always move through coordinated cycles. It's just that most of the time we don't think about it because most of the time markets are generally moving higher. The economy is generally doing well and everybody's going about their business. But when things get upside down, markets start to go sideways. We hear the noise about the possibility of recession. People get very interested in what might be happening. And of course, that's basically where we are today. So as you can see, the yellow dashed line would be our representation of the market cycle, and the blue line would be the representation of the economic cycle. You can see we've pulled the yellow line forward a little bit to represent the fact that investors generally think they're smarter than everybody else. And so the market tends to react before the economy does things. In other words, the market will make an effort to anticipate moves in the economy. And it usually does that. It's I wouldn't call it precise, but it does a reasonably good job of getting it right most of the time. By way of example, the market peak for today's market, the market peaked in December of 2021. It peaked at nearly, if you want to refer to the S&P 500, it peaked at nearly 4,800. We're still only at 4,200 today. So technically, we're still within that bear market that began some time ago at that market peak. When we look at the parallels, it's just today that we're talking about the economic cycle turning over and potentially heading into a slowdown or if a recession if things get really bad. So that's sort of contraction phase. And the cycle then repeats itself. We would go through a down market, we would go through a slowing economy until we get the opposite of where we are today. So today we have high inflation and the Fed trying to slow things down. At some point at the bottom of that trough, we have high unemployment and no inflation, and the Fed tries to goose the economy by doing the opposite of the things it's doing today. And the cycle begins again. And you can see typically investors will start betting on that early and the market will rally before the economy gets better. So that's the cycle that we are living in. So we asked the question, how likely is it that we will have a recession? So we went out and looked for some of the smarter people in the room. And this is a group of 4 economists, professors, reserve board governors that recently issued a statement based on their academic work that says there is no post-1950 precedent for a sizable disinflation, which is what we have today, or what we're trying to make happen today, that does not involve or entail substantial economic sacrifice or recession. So the bottom line on it is whether you call it a technical recession, when the historians get together in a room in a couple of years and decide whether or not we had an official recession, the reality is almost all the time when the government is trying to pull inflation out of the economy, things get tough. Now, does it have to be that way? Of course not. Is it likely that it will be different? No, it's probably likely it'll be pretty much the same. So this is a fairly high probability event that we're going to see some economic pain before the Fed is done tightening the screws. I think of it sort of like being on a diet. When those curves are going up, when the economy's doing well, everybody's fat and happy, you're eating, you're drinking, and so forth, but you get to that point where you can't button your pants anymore, and you have to go on a diet. And you go out to the gym, you hire the trainer, and they kind of whip you in shape. Well, that's exactly what we have today. We've had our fun times, and now inflation has gotten so bad that the trainer has arrived. The trainer is the Federal Reserve, and the diet, the celery and carrots, is the recession. And it's the process that we have to go through to effectively pay the bills for the excesses that we've, let's say, already enjoyed. And the fact is that the Fed is not going to rest until their job is done. We see a lot of statistics about where CPI is and different things. The Fed has made it pretty clear that they're focused on the sticky core inflation numbers. They've even developed a new term called super core, and this is an element of the super core, which basically is wages and services. So this is a picture of services, and you can see recently how the services inflation spiked up to nearly 8%. These are year-over-year numbers, and it's just now started to round the bend and head down. So are things slowing? Yeah, the trend has reversed, and that's good, but it's not nearly where the Fed wants to see it. And that means that their work is not done. They're going to continue keeping the pressure on until not only the overall inflation rate comes down, but these numbers get in line as well. So they may not be raising they may not be raising interest rates because all of a sudden they have a new friend standing shoulder to shoulder with them, and that essentially are the banks as a result of the handful of bank failures that we've seen. But remember, for every bank failure that happens, there are hundreds of banks that are tightening their lending standards. So considering the fact that we are a debt-driven economy and the banking system and the lending from banks is critical, the fact that lending standards are being tightened will certainly help the Fed slow the economy, bringing on the risk of a recession. So there are two things I'd like to touch on. If a recession was going to start, when would it happen? And of course, that goes into that predicting the future, which I said at the outset, we don't think anybody really does a good job at that. However, if you want to look at the averages, recessions on average start about 15 months after the first rate hike. So the Fed raised interest rates last year in March, which would put the average beginning of a recession sometime this quarter. So interesting information. Some people think, the recession should start the week after the Fed starts raising interest rates, and that's not the case. There's definitely a lagged effect of the actions they take, and on average, it takes about 15 months or so to start to see that in the data. And clearly, we are seeing it in elements of data. Things are slowing. They're not crashing, but the trends are reversing and things are slowing down, which obviously is good for the inflation fight. Depending on how aggressive those declines get will depend on inflation. The other common question is, if we do get the recession, and it does affect markets, because remember, it's a double whammy for investors. So when a recession comes, that means corporate earnings decline, and we get a repricing of those earnings. So most people are familiar with the term price to earnings multiple. It's simple math. We take the multiple times the earnings, and magically we arrive at what a number might be that stocks should trade at. And right now, earnings for the S&P 500 are at about 220. So let's say that fell by 10% or so because of a recession, and that would not be an aggressive drop. That would be a reasonable decline if we were going to have a recessionary impact on earnings. And if we applied a recession multiple to that of, say, 16 to 18, that would leave the S&P 500 priced at somewhere between, say, 3,200 to 3,600. Compare that to the roughly 4,200 we're at today, and we could be looking easily at a 20% decline if the recession bites and we get this repricing that we're talking about. So realizing that's the risk that we think about when we think about preparing, if this is the path that things take, what might one do to prepare for that? Well, the first is roll out safety net protection out to 5 years. So we allow our safety nets to contract to 3 when we think things are good, and we stretch them out to 5 years when we think we're at risk. We are at a 5-year, or sort of our outer limit at this stage of the game. We can increase portfolio yield. One of the nice things that happens when the Fed raises interest rates is that the yield on safer returning assets goes up. So to the extent that, remember, our goal is to protect cash flow in portfolios during difficult markets, interest rates that used to be near zero a money market account can yield upwards of 5% today. So that's comparable to a sustainable withdrawal from a portfolio. Finally, it's been a long time since we've had that. Reducing cyclical risk in the portfolio. So if the markets sell off, if we think of the different segments in the portfolio, what segment is likely to get blistered the worst? And cyclical investments are the types that would typically be hit the worst in a recession. So these are things that you don't have to buy. They might be construction stocks, steel stocks, airlines, travel and leisure, things of that nature, things that people can cut back on during difficult economic times. When we say about things to allocate away from, so the cyclical type stocks, there are things to allocate to, and it's pretty much the opposite. What things do people need to buy during difficult economic times? And that would be things like healthcare, toilet paper, utilities. These are the sorts of things that people have to buy whether the economy is good or the economy is difficult. We want to read over, so that would be staying fully invested. A tactical investor might reduce their allocation to risky assets. So they might say, I normally have 60% of my portfolio invested in stocks. I'm going to reduce that to 50% to basically raise cash. Probably the safest of all investments if you don't worry about it being eroded by inflation. We can increase duration in the portfolio, which basically means if the, as the economy was getting stronger and interest rates are going up and the government's raising interest rates and so forth, when the economy starts to slow down, i.e. in a recession, it's likely that interest rates will decline. If you have increased duration, then then bonds will appreciate in value as interest rates decline. So buying longer term bonds is essentially what increased duration alludes to. And the final piece here is active rebalancing. So we talked about reducing the allocation to risky assets for tactical investors. Those are people who will increase or decrease their allocation to risk assets. Other strategic investors choose not to do that, but here active rebalancing is a very important element. So think of it as a sort of forced dollar cost averaging strategy. So if stocks decline in value because the market has fallen, you would essentially take money from your bonds, which have gone up because of the increased duration, selling high, and buying stocks cheaper because they've declined as part of the recessionary outcomes. So I'm going to hand the ball off to Dan now, and he's going to counterpoint my recession argument here.
Absolutely. So the two scenarios we're looking at is the recession scenario and the no recession or shallow recession, often called the soft landing scenario. So in a soft landing scenario, that likely means the Fed will hold rates higher for longer. They've said they're going to do that. They're not going to cut rates, at least for the rest of the year. In a soft landing scenario, they will probably hold rates for the rest of the year above 5. The economy will continue to slow, but it doesn't meaningfully retract into recession. You might see a shallow technical recession, but in a soft landing scenario, the recession would be shallow and pretty quick. Inflation in this scenario would continue to fall as demand would wane due to the Fed creating tighter financial conditions. Employment will continue to remain strong despite pockets of layoffs in the technology sector. And essentially for this soft landing scenario, HCM's timeline for economic slowdown in the back half of 2023 remains. We still believe in that, but a soft landing due to a resilient economy may push the slowdown into 2024. So it really could just be pushing the timeline back of the economic slowdown. So when we're looking at a soft landing scenario, there's a few things that we need to happen. A lot of data that we watch really closely, a few really prominent data points that we're looking at really start to shine in an environment where you're looking for a soft landing. So the first one is retail sales. So you cannot have a soft landing without a strong consumer. And as you can see on this chart, over the last 3 months, or for the first time in 3 months, retail sales is actually climbing. You have a strong consumer. If the consumer remains strong, it's very difficult to see a scenario in which a true deep recession comes to fruition. The next one we're looking at is businesses, manufacturing businesses specifically. So on this chart, the orange line on the bottom, the oscillator, shows the global composite PMI, which is the Purchasing Managers Index. This is essentially showing the prevailing direction of economic trends in manufacturing. When the orange oscillator is above the 0 line, that means global growth is accelerating. When the orange oscillator is below the 0 line, that means global growth is contracting. These are 3-month rolling bars. So as you can see on the far right, over the last three-month rolling periods, you've had accelerating global growth. And that's essentially, the manufacturers are essentially the lifeblood of the economy. As you can see, the line on the top, the blue line, is actually the MSCI ACWI. So that is the All Country World Index. So that's essentially every stock available across the world, United States and all over. So when you see the bars go above the 0 line significantly, like it's starting to, if you look at the corresponding points on the MSCI ACWI, you can see that there's some pretty significant market bottoms and troughs in there. So if we're looking for a soft landing, we absolutely want to see this number above 0 and continuing to increase. So far, the evidence is showing that global growth is accelerating. Next, we need earnings. As Mike mentioned, an earnings drop really changes the multiples that you use to fair value the S&P 500. When we look at earnings, we look at the base numbers, and we also look at earnings surprises. Over this recent quarter, we're not fully through the earnings period, but we have 94% of companies earning earnings in. Over 78% of them have reported positive earnings surprises. That's a really significant number. We want to continue to watch that and make sure that we are beating expectations. We do expect earnings to slow, but as long as they don't go negative, we still see a path for a soft landing. And employment, that this whole entire market cycle, employment has kind of been, I'm not going to say a miracle, but it's been very impressive. So the gray bars on this chart represent recessionary periods, and the blue line on this chart represents the unemployment rate. So when you're looking through, this goes back to, I think, 1960. As you're looking through, you see the gray bars come up, the unemployment spikes a little bit before the gray line, and then rapidly throughout the recessionary period. So in 2008, 2009, the 2000 tech bubble, the 80s, you see really rapid spikes in employment. And this is one that we watch very closely. We look at this just about every day, because it's very difficult to say we're going to have a significant recession if the unemployment rate is at these historical lows. So in a soft landing scenario, we have to keep a really close eye on the unemployment rate and make sure it remains low and does not spike and send us into recession. And then from a technical perspective, it's been a pretty crazy start of the year, especially for technology stocks. So the NASDAQ 100 actually made new 52-week highs. So that's a full year in which we're breaking out of new highs. When you have a big base, a year long is a big base, and you're breaking out to new highs, that is very bullish from a technical perspective. That's the lifeblood of bull markets. The S&P below that, you're starting to see higher lows and higher highs. And again, that is the type of market environment that you see in bull markets. So, we would want to continue seeing the S&P making new highs and putting in higher lows, because that's the market structure, which really makes the soft landing scenario very believable. So how we would prepare for a soft landing. So it wouldn't be on the fixed income side, we would still want to be holding money market positions. The Fed's not going to be cutting rates in a soft landing scenario, and those money market positions are spitting off 5% interest, which is fantastic for no real market volatility. Also, if the Fed is holding rates at elevated positions, yields should rise. And when yields rise, you want to be holding shorter duration assets. So we would definitely be keeping our heavier money market position. But if yields rise enough, we would probably look to be opportunistic to add in duration, but we're definitely not there yet. A soft landing scenario would get us there. We'd potentially increase small caps too. So from a valuation perspective, relative to large caps, small caps are insanely cheap. The issue with small caps is they are very sensitive to recession. So we would have to be very careful with increasing our small cap positions. So they're sensitive to recession because they're a lot of cyclical businesses, which Mike talked about, we don't really want to own. And they have a lot of exposure to regional banks. So there's a lot of risk in small caps. We would really want to make sure the regional bank the regional bank bankruptcies are over, and we want to make sure that cyclicals are really getting a bid before we add small caps. We'd probably maintain a neutral equity allocation. As I mentioned earlier, this soft landing scenario really might just be kicking the can down the curb. And again, this would be very data dependent. There's a potential in which the economy comes out of this and really rips, and we could go overweight. But going into this soft landing, we would definitely want to be holding a neutral allocation. We would do frequent rebalancing. That's one thing Mike and I really agree on. Rebalancing is great in a soft landing scenario. We want to make sure that we're taking profits on equities as much as possible if we do get a little bit of a bull market going forward, because again, the recession might be kicked down the road into 2024. And then we really encourage clients to reestablish their risk tolerance. There's a lot going on. We have the debt ceiling, we have potential recession. We want to make sure that we are allocating the portfolio appropriate to your risk. We want to take a look at our safety net, our bond ladders. We want to make sure that our bond ladders are covering our expenses for 5 years. And then we just want to make sure that your portfolio is matched up with your risk so you can sleep easier at night going through these really unprecedented times.
Yeah, and I think one point to bring up too is if you look at the current positioning in terms of portfolios right now, I think you can take kind of ideas from both of these scenarios and see them in action with some of the trading that's taken place. I think the soft landing scenario is probably, what would I say, a lower probability event. But again, there's a lot of recession data points that simply aren't really indicating that it's at our front door right now. Mm-hmm. So we certainly don't want to overweight any of the scenarios when you're getting mixed signals like we're seeing right now. So I think that's a point that I want to make is that we're planning for each of these kind of without the conviction of either one at the moment is really the best way to put it. So we've had several questions come in, so let's go ahead and get to those right now. So the first two really are more debt ceiling related here. First one is, can you explain why we keep hearing about the 14th Amendment? So the 14th Amendment actually has 5 parts to it. And really what's being referenced here is the 4th part, which references, I think the line is that the validity of the U.S. public debt will never be called into question. Now, to have some context around this, this was, instituted because back in the Civil War, some of the Confederate debt, so to speak, was basically wiped out. And the government wanted investors to feel confident that going forward, the new country, so to speak, would always honor its debt. So there's been some interpretation around that wording that says, regardless of what this debt ceiling says, that the Treasury or the president or whoever has the authority to do this can just say, you know what, based on this amendment, I don't care what the debt ceiling is. We have an obligation to honor this. I think you would see a lot of legal pushback. I think you'd see a lot of political pushback implementing something like this, simply because it's almost kind of a way to circumvent the law, so to speak. So I'd have a hard time believing that that's going to happen, but it's probably why you're hearing more about this 14th Amendment coming up. And then one of the other questions was, I've been reading that the U.S. actually has defaulted on their debt before. So I guess the answer to that is yes and no. So there are 4 instances where I guess you could consider a default a possibility. So one was back again when the U.S. was trying to finance war efforts in the Civil War. And this is when the idea of printing money actually came about, because back in the 1860s, money was backed by either gold or silver or something to limit the supply. And in all these instances, again, in 33, you had gold bonds that were supposed to be redeemable in gold, that they said, you know what, we're not giving you gold for these. We're going to give you paper money. Again, in the 60s with silver certificates. And then finally in 71 with Bretton Woods, where again, you have a gold issue where Nixon basically said, you know what, we're not going to give you gold. We're going to give you dollars for this. So it wasn't necessarily an issue that they couldn't pay back the obligation. It was just that they paid it back in a currency that wasn't originally the currency that was supposed to be given. So I can see both sides of that. But for the purposes of, I think, what we're talking about now, I think it's fair to say that we've never had a U.S. official default on bonds. So we kind of touched on this a little bit, but I'll let you guys chime in here. What, in your opinion, would be kind of a real-time indicator that recession is kind of at the doorstep, so to speak?
I can jump in. So
Sure.
I wouldn't pick an indicator. I think that the troublesome one in terms of calling the recession, which Dan's already alluded to, is unemployment. One would expect to see that begin to turn up. There are lots of explanations as to, and I might even put them in the excuse category, but there's lots of people who want to explain it away by saying, people are still at home on their couch because they're spending their COVID checks. There's the great retirement that during COVID, people who were still in working years retired and don't want to come back to work. They've lost their technological skills, whatever the case may be. But simply that the pool of available workers has declined, meaning that those willing to work have gone up. The other thing that has happened is wages have increased. Not so much lately, but last year. And so that did get people back into the workforce. So watching the unemployment rate would be a biggie. Retail sales, we are a retail-oriented country. There's an indicator called the PCE, which the Fed keeps an eye on. It basically keeps track of personal spending, which makes up about 70% of our GDP. So should that begin to decline, personal consumption expenditures, by the way, should that begin to decline, that would be an indication that retail is giving up the ghost. It is declining now, I believe, but the trend is down, but it's still strong at a 4% growth rate. So some of these things, when we talk about inflation being sticky, or the rate of decline is not fast enough to meet the Fed's data requirements, which is, we're not saying that inflation is not coming down, but the Fed is also opposed to it lingering around or going slowly because it becomes embedded and creates a whole other tier of problems. So they are anxious to see the problem solved. Bank lending, we've a couple of seminars ago, we were talking about Silicon Valley Bank, which was sort of the beginning of the regional bank crisis. But to the extent that that has created tighter or more restrictions or tighter restrictions with regard to lending is an important observation, because we are we're a retail nation. We spend money and we borrow money. So to the extent that borrowing becomes difficult, things will slow down. So keeping an eye on lending for people who want to borrow money, that lending is available to keep the skids greased is one thing. The opposite side of that is credit card borrowing. People who continue to spend even they don't have the money, and it winds up going on credit cards. That is, something that can't last forever, and credit card balances are on the rise. I think Dan might have mentioned this in one form or another, but there's a thing called the ISM Purchasing Managers Index, which keeps track of sort of economic activity. This is the Institute of Supply Management, also trending down, but I believe still positive. I think it's still sitting at 52. Anything over 50 is a growth number, but growth is declining. So I would say a culmination of these trends that are still positive but declining are the canary in the coal mine. But that big one is employment. Unless that changes, I think this is going to be a hard conclusion to get to, which implies that the Fed keeps rates higher for longer until they get what they need to get, which is break the back of inflation.
Sure. So, Dan, question about market breadth, concern about the fact that only a handful of stocks have been seemingly driving a lot of the rally that we've seen so far. Kind of what's your thoughts on that?
Yeah, I mean, it's, you have some of the biggest stocks in the S&P 500 really driving the market. You have two kind of scenarios there. You have those large stocks that are driving the market fall back down to the rest of the market and kind of cool off, or you have the rest of the market catching up to those larger stocks. So essentially breadth improving. So when you look at the trend of the market, you look at the QQQ equal weight, that's not increasing and performing as well as QQQ, but it's still a positive number. RSP is the S&P 500 equal weight. It's lagging the S&P 500 pretty significantly, but it's starting to turn up a little bit. Mm-hmm. So there's evidence to suggest that the rest of the market could potentially catch up with those big names. But that's definitely something we will be watching because as those big names go, the market goes. So you need to really be watching those big companies. They need to be performing as well. But sector rotation is kind of what really drives the markets. So if there's positive sector rotation and size rotation, that could be a positive thing.
Question about kind of the fixed income area and money markets in terms of a recessionary environment, and maybe which one is the better option. Mike, I think you talked earlier about increasing duration. Historically in a recession, the Fed has cut rates as a way to try to jumpstart the economy, so to speak. In a scenario like this, when you think of money market funds, those rates are going to be based on very short-term interest rates, ones where the Fed has direct control over those. So in an environment where you'd see recession, I would expect for money market rates to come down at some point as the Fed cuts rates. And the counter to that is that rates across the curve would likely move lower. The more duration that you own, the more price appreciation you would get. Now, that's the historical relationship. We saw that break down a little bit last year, obviously. But even with money markets yielding 3 or 4% in a recessionary environment, you're probably not going to go wrong holding some of those assets in your fixed income allocation for some protection there. And then one last one regarding AI. It's kind of been a big buzzword in the news over the past few months. The question is really kind of what do we think about AI? Are there certain areas that we think are better than others? Mike, I know you've got some good thoughts on what AI could do to productivity, so I will let you handle that here in a second. What I would caution a little bit with the whole AI thing, I think with a lot of these new hot trends, I think they can get a little bit ahead of themselves. So I think the world of AI is still young, obviously, and it's accelerating quickly. But I think some of the individual companies that have been associated with AI, and we can't really name any of these specifically in this format, may be getting a little bit ahead of themselves. So I would certainly be careful for that. But I think long term it would certainly be a net positive for a lot of areas of the economy. So Mike, I'll let you kind of expand on that a little bit more.
Yeah, so I use that as an opportunity to just kind of sum up our current view looking forward, which kind of takes into account the things we've talked about. In the very near term, and I'm going to go back to where I started. Remember that our primary job is to make sure that we protect our clients' cash flows, their growing cash flows during good times and in bad. So that's the mission. With that said, in the relatively near term, meaning this whole debt ceiling debate, we think that the argument can create some friction that when it's relieved, risk premiums will be resolved and prices could go up. Investment prices, interest rates, or bonds, stocks could go up because that risk would be peeled away. We think that's fairly short-lived because most of the world appreciates the fact that we're going to solve this problem one way or another. We just have the political kabuki theater to endure while the process goes on. Once we get beyond that, then we have to deal with this issue of mild recession, big recession, those sorts of things. Our guesstimate is based on the strong employment market, we see a modest recession that will likely bring earnings down and probably, if history is a guide, have some lower multiples. So we do have some price exposure there. And you can see in the things we've done, we've already described, we've taken some of the cyclicality out of the portfolio. We are holding portfolios at neutral equity weightings at this stage of the game, however, because at this stage of the game, things just don't appear. The signs are not in front of us to suggest that chips come off the table. The real bright spot here, though, I believe, is AI, and not to pick a couple of winners, because I don't think that's the answer, but artificial intelligence has the ability to be one of those sort of life-changing technologies. Think back to the PC coming onto the market. Think back to the beginning of the internet. This has that kind of change to be able to bring an extra 1% or 1.5% productivity into businesses, which doesn't sound like a lot, but that's huge. And especially with the government that's grappling with inflation problems, if the market begins to appreciate that there's going to be improved productivity, that is like the magic pixie dust that can be sprinkled on top of a lot of these problems and they just melt away. So with that said, our little bit longer term view after this whole recession question gets resolved is for the potential to have the type of a bull market that followed the PC and the internet. So, a good decade-long run while the benefits of these things get built into everyday corporate America.
Great. So yeah, I think that's all the questions that we have. So Mike, if you want to go ahead and take us out.
Yeah, so I want to thank everybody for participating. We will be repeating again in 2 months, Doug?
2 months, July, unless things become newsworthy in the meantime.
So if we've done anything if anything becomes newsworthy, we'll obviously be right there. Otherwise, if you have any specific questions, you can reach out to any of the people on the call today or your advisor. I'm happy to get the questions resolved. If you know anybody that we can help, happy to do that, no strings attached. Otherwise, I think that wraps it up for today. Thanks everybody for participating. Bye-bye.